Hey everyone, welcome back to Corporate Decoder. Today, CMS Energy Corp just filed an 8K announcing an equity offering program, and I am seeing a significant move to raise cash. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is looking to raise up to $3 billion by selling its common stock, which could mean big changes for existing shareholders. So what exactly is happening here? CMS Energy Corporation, a Michigan-based company that provides energy services, is launching what they call an equity offering program. Think of it like this: they're planning to sell up to $3 billion worth of their own stock over time. This is a pretty substantial amount of money they're looking to bring in. The filing is dated May 13, 2026, and it details the plan to offer and sell shares of their common stock. It is important to understand that this is not a sure thing. CMS Energy has no obligation to sell any of these shares. They will decide to sell them based on things like market conditions and whether they need more funding. The shares being offered are their common stock, the same kind that is traded on the New York Stock Exchange under the ticker symbol CMS. This is the core ownership stake in the company. The program is set up through something called an equity distribution agreement. This agreement involves a bunch of financial institutions acting as agents or forward purchasers. Essentially, these banks will help sell the stock on behalf of CMS Energy. They might borrow shares and sell them, and then CMS Energy will eventually settle these transactions. Here is a key point that people often miss in these types of filings. When the banks acting as forward sellers borrow and sell shares, initially, CMS Energy doesn't get any money right away. They expect to get cash later when they physically settle these forward sale agreements. But there is a twist. CMS Energy has the option to settle these agreements in cash or by delivering shares. If they choose cash settlement, they might have to pay money. If they choose net share settlement, they might have to give up more shares. In these scenarios, they might not receive any proceeds at all, or they could even owe money or shares. This means the amount of cash they actually raise could be less than the $3 billion initially targeted, or it could come with significant future obligations. The sales can happen in different ways. They can be privately negotiated deals, or they can be at the market offerings. At the market offerings are common for big companies. They basically sell stock gradually into the open market at prevailing prices. This usually minimizes the impact on the stock price compared to selling a huge chunk all at once. So this offering is happening under CMS Energy's existing registration statement filed with the SEC. This is a standard process for companies that plan to issue stock periodically. It basically pre-approves the framework for these kinds of sales. Now let's put this into context. CMS Energy is a regulated utility company. These types of companies typically have stable earnings and pay dividends, which is why you might have seen news about their recent dividend declaration and positive Q1 earnings. They are also planning a massive clean energy build-out. However, the need to raise up to $3 billion through stock sales is quite significant, while utilities are generally seen as stable. A move like this often signals that the company needs substantial capital for growth projects or to manage its existing debt. They currently have a low PE ratio of 3.7, which some might see as a sign they are undervalued, but it could also reflect investor concerns about future growth or debt. This offering is comparable to other utility companies that have needed to fund large infrastructure projects. For instance, when some utilities have embarked on major generation upgrades or grid modernization efforts, they've turned to equity offerings to help finance these capital expenditures. The key difference here is the size of the offering relative to the company's current market capitalization, and the potential impact on share dilution for existing investors. If CMS Energy successfully sells all $3 billion worth of stock, it means a substantial increase in the number of shares outstanding. This dilutes the ownership stake of current shareholders. Imagine you own 100 shares. If the company issues another 100 shares, your 100 shares now represent a smaller percentage of the company. This can put downward pressure on the stock price unless the new capital is invested in a way that generates significantly higher future profits. Looking at the potential strategy here, CMS Energy could be trying to fund its ambitious $24.1 billion clean energy build-out. Raising this much cash might allow them to avoid taking on too much additional debt, which could jeopardize their financial stability or lead to credit rating downgrades. On the other hand, if they are selling stock because their operations are struggling or they are unable to secure debt financing, that would be a more concerning signal. The fact that they offer flexibility in how these shares are sold and settled means the ultimate cash received and the impact on shareholders could vary. The most favorable scenario for CMS Energy would be to sell these shares through at the market offerings at prices that reflect the company's fundamental value. The least favorable would be if market conditions force them to sell at depressed prices, or if they face significant cash settlement obligations. My biggest concern is the potential for substantial dilution to existing shareholders. While raising capital is necessary for growth, especially in the energy sector with its high capital requirements, the sheer scale of this $3 billion offering warrants close attention. I will be watching to see how much of this offering is actually executed, and at what prices if they manage to deploy this capital effectively into their clean energy projects. It could be a positive long-term move. However, without successful execution and improved profitability, significant dilution can weigh heavily on the stock. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.